Welcome to Iggy's Insights, where we dive deep into economic topics that matter. I'm your host, Iggy, and today we're exploring a perspective that might challenge your thinking about tourism-dependent economies through the lens of Thailand's experience. Let me begin with a historical parallel that shaped modern economic thinking. In post-war Europe, nations like Greece and Portugal built their recoveries around mass tourism, creating entire regions dependent on seasonal visitors. When the 2008 financial crisis struck, these economies collapsed faster than their diversified neighbors. Tourism-dependent areas saw unemployment rates triple within months, while regions with mixed industrial bases weathered the storm. This pattern of vulnerability isn't accidental, it's systemic. Thailand's story mirrors these historical warnings, but adds critical modern dimensions. Before borders closed in 2020, Thailand welcomed nearly 40 million annual visitors, more than its entire population. Tourism accounted for 20% of GDP and employed 17% of workers through direct and indirect jobs. When COVID-19 hit, this apparent strength became catastrophic weakness. April 2020 saw zero international arrivals for the first time in modern history. GDP contracted 9.5% that year, worse than the 2008 global recession's impact on the United States. But this crisis wasn't novel. It revealed structural flaws inherent in tourism-led development models. Today, we'll dissect Thailand's economic journey through three analytical lenses: historical dependency patterns, systemic vulnerabilities exposed by global shocks, and alternative pathways emerging from this crisis. Thailand's path to becoming a tourism powerhouse began under unique geopolitical circumstances. During the Vietnam War, U.S. military personnel transformed Bangkok into a rest and recreation hub. This accidental seeding created infrastructure and service networks that later commercial operators expanded. From 80,000 annual visitors in 1960, Thailand crossed 1 million by 1970, growth directly tied to Cold War geopolitics rather than deliberate economic planning. The 1980s marked a strategic shift. Facing declining agricultural exports, Thai policymakers consciously embraced tourism as an industrialization alternative. Tax incentives for hotel construction, streamlined visa policies, and aggressive international marketing campaigns followed. Visitor numbers grew exponentially: 3.5 million by 1987, year of Thai tourism, 10 million by 1999, and 39.8 million at 2019's peak. This growth created what economists call a monoculture economy in key regions. By 2015, tourism constituted over 80% of Phuket's economy and 65% of Chiang Mai's. Traditional industries like rice farming and textiles atrophied as labor shifted towards service sectors. The World Bank praised this transition as successful modernization, ignoring the concentration risks we'll analyze next. Tourism-dependent economies face three fundamental vulnerabilities that Thailand's crisis exposed. First, demand elasticity. Luxury tourism collapses fastest during crises. Thailand's 2020 tourism revenue fell 82% compared to 47% for manufacturing exports. Second, labor precarity. 63% of Thai tourism workers lacked formal contracts pre-pandemic. When borders closed, 2.3 million jobs vanished overnight with no safety nets. Third, revenue leakage. Studies show only 35% of tourist spending remains in local economies. Global hotel chains siphon profits offshore through franchising fees and imported supplies. The pandemic amplified these structural flaws. Thailand's central bank reported tourism-dependent provinces experienced 22% income declines versus 11% in manufacturing zones. Environmental costs became visible too. Maya Bay's coral reefs began recovering during closure, revealing mass tourism's ecological toll. This crisis wasn't unpredictable. From Spain's 1970s tourism crash to Caribbean nations' hurricane vulnerabilities, history shows tourism monocultures eventually face reckoning. Thailand's distinction lies in its scale. No economy had ever concentrated so much GDP in such a volatile sector. Thailand's response combines crisis mitigation with long-term restructuring through three key initiatives. The BCG economic model, adopted in 2021, reimagines tourism through sustainability metrics. Pilot projects like Nan Old Town demonstrate energy self-sufficiency through solar microgrids, waste-to-resource conversion systems, and cultural preservation quotas, limiting visitor numbers. Early results show 40% higher per tourist spending compared to mass market destinations, though scalability remains challenging. The Eastern Economic Corridor, EEC, a $45 billion industrial zone, diversifies into advanced manufacturing and tech. By 2024, EEC attracted $12 billion in electric vehicle investments, Southeast Asia's largest data center cluster, and regional headquarters for 23 multinationals. The EEC now contributes 15% of Thailand's GDP while employing 600,000 workers in higher value sectors. Cooperative restructuring, inspired by worker-owned enterprise models, helped transform 327 failed tourism businesses into member-owned cooperatives by 2023. Chiang Mai's Handicraft Collective exemplifies this shift. Worker owners now earn 300% more than pre-pandemic wages through direct international e-commerce. Thailand's experience challenges neoliberal development orthodoxy in three ways. The efficiency fallacy. Markets optimized for tourism growth created catastrophic systemic risk, what economist Hyman Minsky called stability breeding instability. Labor value extraction. Traditional tourism models function as wage arbitrage, paying Thai workers 73% less than equivalent service jobs in tourist home countries. Alternative ownership models. Worker cooperatives in the EEC zone show 28% higher productivity than traditional firms, undermining claims about private ownership superiority. As Marxist economist Richard Wolff observes, crises reveal what normalcy obscures, the fundamental contradictions of profit-driven development. Thailand's tourism collapse laid bare capitalism's inability to balance sectoral growth with systemic resilience. For global investors, Thailand's restructured economy presents both warnings and opportunities. Risks include tourism-reliant rates still carrying 40% valuation premiums despite reduced demand, and luxury hospitality oversupply persists. Bangkok's hotel occupancy remains 22% below 2019 levels. Opportunities include EEC tech firms reporting 34% annual revenue growth, sustainable tourism startups attracting $800 million VC funding in 2024, and cooperatives now accessing $2.1 billion in government-backed low-interest loans. The key lesson? Diversification matters. Investors prioritizing mixed economy regions, EEC provinces, grew 5.2% in 2024 versus 1.8% nationally, outperformed those chasing tourism's false recovery. Thailand's journey from crisis to reinvention offers a roadmap for over 50 tourism-dependent economies worldwide. By combining strategic state investment in high-value sectors, worker-centered ownership models, and ecological carrying capacity limits, Thailand demonstrates that post-crisis rebuilding can mean more than restoration. It can catalyze systemic transformation. As global shocks intensify from climate change to AI disruption, Thailand's experiment in economic resilience deserves close attention. The ultimate insight? No economy can thrive by simply selling sunsets and souvenirs. True prosperity requires building systems where workers share ownership, communities control development, and growth means more than GDP statistics. Thailand's path remains uncertain, but its willingness to confront tourism's contradictions offers hope and a challenge for us all. Thank you for joining this analysis. I'm Iggy from the Investing Iguana, reminding you that understanding economies requires seeing beyond surface-level success to the structures beneath. Until next time.